All right, all of that being said, we're going to navigate over to the Power Options suite of tools, which of course I'm going to use to help us illustrate the answers and concepts of the questions that you asked today. There we go. And let's see here. Jose starts us off a little bit. Jose says, hi there. It's Jose from Mexico. Hello, Jose. Thank you for joining us from Mexico. I hope things are going okay for you down there as well. Okay, and then there's questions from Dan. There's Octavio's back. Okay, another question from James as well. Okay. And William says, hello, Michael. Can a married put position be put on with a long call instead of the long stock? If so, what delta would you use for the long call, and how far out in time would you go with the long call? Thank you for your help. Okay. Now, I don't know if I have it here. I don't think I have it available in the webinar section. I'll look it up on YouTube after this, William, and I'll send you the link, but I'll try to find it on YouTube as well for you. There's a series of webinars I used to do on a regular basis. It was called 3 Core Principles and Strategy Comparison. And what we would do in that webinar is look at the 3 core principles of radioactive trading, the limited risk married put techniques as described in the blueprint. And, that forced into proper position sizing based on the structure of the stock and the put. Okay, so proper position sizing, sorry about that. The at-the-money bell curve, which signifies why we want to be buying puts that are in the money for best protection, not at the money, and of course why we want to be selling at the money as well. And then, of course, the time decay curve. Why are we buying puts that are 120, 150, 180 days out in time as opposed to 60 or 90 days out in time? And it's related to time decay. That's the 3 core principles. But of course, you're asking the right questions. And these are the same questions that I asked Kurt. He was a member of Power Options. That's how we got introduced to him. He'd already written most of the blueprint. We expanded it when we purchased the rights to radioactive trading in the blueprint, and we're working with Kurt and still working with Kurt. But when he first brought it to my attention, I asked him, why are you buying a put so far out in time? It's so expensive. You'd be better off buying short term. And he showed me why that was wrong. But at the same time, I said, okay, well, we're partnering up with this guy, Kurt. I'm going to go through his material. But why would I do this? Aren't there better ways to get into a protected position? Instead of, and this was in 2007, 2008, mind you, and I said to myself, instead of buying the stock, if I want the protection, why don't I buy that 6-month out put and then sell an at-the-money put option to get into the stock at a cheaper price? In other words, why not get into the stock with a naked put or a calendar put spread, knock off some of the cost, and have a better, lower risk position to start? Or what if I bought a leap in the money call, because I was trading diagonal calendar spreads at the time, William? What if I bought the in the money call instead of the stock and still use the same put? This creates an in the money long strangle position. And then, of course, why not just use a long call? And that's because the lie of leverage comes back to get you if you're not safe. So your answer is here, replacing the stock in the married put position with an in-the-money long call position. Now, one thing on this one here, this first one I mentioned with a calendar put spread, I did 4 of these and tracked them side by side with married puts that I opened them. Unfortunately, exactly what happened, why we don't do this anymore, it's a different strategy. 3 of the 4 positions I did is that calendar put spread ended up moving up about 6 or 7% in the first 20 days. So I made my little bit of profit here, lost a lot on my long put, and would have had a profit of 4 or 5% if I just opened the married put instead of trying to get in the position with a diagonal put spread. Okay, so all that being said, why, if we used the long call, what delta would we use and what would it look like? Well, let me pick a good stock here. This is our married put search results. This is what I would go to, and this is the list that I would choose from if I was opening a married put position today. And I was looking at a few. Dropbox was interesting to me because it was a low price. A lot of things are down today. Just looking for a good medium price stock, so I guess we'll just stick with one of Ernie's. I'm pretty sure he's in Qualcomm. So if I opened a married put today, well, it shows me that we could buy the stock, at 75.17, and buy the October 80 strike put. That'd be the proper structure, for a risk of about 707 or 8.1%. William, this might lower as we go into midpoint, but not by much. Okay, so there's not a wide bid-ask spread. Lowers it down to 697 or 8% risk at midpoint pricing. Now the break even, I'm going to jot this down, is 86.96. Keep in mind, that is at October expiration. Okay, it's not right now. That's at October expiration. The curved red line on our profit and loss chart shows us that if the stock's trading at 80 at the halfway point on July 27th, we'd be around break even, maybe at 81 or $80.50 or so. If the stock moves up 2 points, small amount, just to 77, let's say, 77.25, in the next week or two, let's go out to 513, why not? Okay, we'd expect a small profit of about $9 or $10. Okay, so if we're at 77.25, we'd have a small profit of about $10. Let's just call it $10. Okay, 10 cents per share, $10. All right. Now I just wanted to bring that up. Now in this case, one could say, William, that if I'm willing to go to this strike, the 80 strike, which is 5 points out of the money, what would the structure look like if I went the same range out of the money? And I'm not saying to do this. You'll see why in a second. But if I just went to the 70 call, that's about $1 time premium. Well, I'm sorry, it's about $6 worth of time premium. So I'm the same distance apart from the stock, pretty close. Okay, 1 to 1 there. Here's my in-the-money long strangle. Because of the extra time value cost on this position, the risk goes up. Almost doubles. Remember, we were at 697 or 8%. Now we're at 1285, which represents 56.2%. Now, I'm not investing 8,986. I'm only investing 2,285. But I'm risking 56% of what I invested if the stock stays between the two strike prices. Okay? And what happens in a couple weeks if the stock goes up to 77.25 on May 13th? There we go. I'm at a loss of about $20, okay, instead of being at a profit at 10. Now, this might not be a fair assumption, or a fair comparison, my apologies. And the reason why I say that is because, okay, oh, sorry, there, just looking through some of these as well. Okay, so the reason we're looking at it in this fashion, sorry. Wow, okay, I still got a lot of questions coming out, just making sure that there's, I'm looking for comments here as well. Wow, okay, no problem, guys. I'm up to about 22 questions, it looks like. Okay, so that's fantastic. This is not a structure I would use, being this close. And I'm not going to use this structure anyway, but if you wanted to have a better structure than this, with this increased risk that almost doubles, which we commonly see in the comparison of in-the-money strangles, you probably want to go deeper in the money. It's going to be more expensive, but you're looking for less time value. We're going to still try to apply the at-the-money bell curve. So let's go back to Qualcomm. Let's go into October. And let's go deeper. Let's go all the way down to 60, which is probably going to be, we'll check it, but it's probably just going to be a 0.75 or 0.8 delta, almost the same delta I would look for if I was using a diagonal spread. Okay? All right, so this one's going to run me $17.80, so I'm only paying about $2 extra of time premium. The risk goes up to $9.60 from $8.96, but I'm still risking 32.4%. It's leverage. The lie of leverage works both ways. It's a higher percentage at risk on the position. Yes, you have the chance to profit in both directions. But if, again, we're not talking about expiration. We know that's all the way to October, but you'd need a drop down to 50.40 or 89.60. Even with this structure, if the stock went up to 77.25 on May 13th, It shows me that we're at a decent gain on this position higher than before. That's pretty good. And that's because you're looking for that higher skew. I don't use this position. I don't recommend using this position. Why? One, because you increase the risk to double digits, and that's not what we're trying to do. We're trying to keep it to single digits. If you're going to use leverage because you want to pay less, you're going to take a higher percentage increase, and it's also a higher monetary risk than the married put by itself. Okay? Number two, this position is not delta neutral. It is delta opposed, meaning that typically, in this example, it proved to be okay. But with that other strike difference, when we went to the 70, if we would have gone to the 65, what you see is that you need a larger movement in the up direction to start realizing a profit compared to a married put. What's the advantage of this structure is that, well, if you're wrong, you can profit to the downside as well. But again, you need a much larger movement to clear the delta opposition before one delta really starts to get higher than the other and starts countering the losses. Okay, so you start off delta opposed, not delta neutral. In the married put, if I'm looking for a bullish stock and it goes in the direction that I want, in that case, then I'm going to see gains faster in that situation. Okay, and okay, so we've got the increased risk delta opposed. Number three is the income methods drastically change the structure of this setup. Okay, so it doesn't give you a preferred profit and loss chart based on what your goals are. Yes, you can still roll up the call or roll up the put as the stock moves up and make adjustments on those. But let's just take income method number one. If I had gotten into our married put and I'd bought the 80 strike put with that risk of 8%, the stock moved up to 80, I might sell the May or maybe the June 80 call for a reasonable premium. And you know, we'd have a standard sort of diagonal collar profit and loss chart, William. But in this case, if I try to create a diagonal calendar spread with the put option, I know June's far out in time, but let's go with the 80, and I'm actually going to increase it up to about $4 because it would be at the money where I'd want. Whoops. All right. Now I get something I really don't like. I get something that if the stock moves up immediately past the 80 strike and continues, I just start losing money. Because what have I done now? I've sort of completely hedged. Yes, now I have virtually no risk if the stock falls in this case in the short term to June expiration. But what I've done is cap the upside, so I'm countering the positive delta I would have had on this 60, whereas if the stock continues to move up, all I'm doing is losing on the put. Whereas in the married put structure, you know, we'd see something like this that might not go negative to the upside. And this isn't that big. It's pretty big, though. It's a near $400, $500 loss if the stock continues to move up or it gaps up after we sell that call. And the max loss, of course, there it is, 560. But it'd really have to ramp up to 140 range and so forth. But the income methods become completely different in that structure. So in general, that's why I don't recommend and I don't suggest using the in-the-money long strangle as a substitute for the married put position because you're changing the structure. Yes, you've given yourself two ways to win, but at the same time, you've got to fight two time values, even if you go deep in the money, a delta of 0.8 or delta of 0.85. Why don't I check that real quick while I'm here? Research and stock research. Oops, I apologize. Delta. I wanted option research. Fantastic. All right, so delta's, oh, it's not there yet. It's a 0.77. So you could go to a lower delta. You're still going to have some time premium, but the more you pay for that call, the more movement you're going to need to see to start seeing a profit. Okay, that's sort of the key, is that you need more movement to the direction there in order to get that as well. Okay? All right, so okay, real quick. So that's the in-the-money strangle. And let me pause the screen very quickly. I should have done this before, but I didn't. I think I'm still logged in here. I know you're still looking at the same screen. Bear with me 1 second, ladies and gentlemen. Let me just log out of YouTube. Okay, let's go to Power Options. All right. Excuse me, ladies and gentlemen. Okay, so all right, here we are on the Power Options screen, and you can search the channel, of course, and I'm going to search for 3 core principles. 3 core principles. We look at comparison investors. That's radioactive marriage setup. Okay. Well, I think I want to go with. It might be this one. I hope it's this one. There are varieties of this one. Sometimes I show certain things. And let's see here. Same as long call. And that's it. Okay. So this is the one where after we discuss the 3 core principles for about 25 minutes or so, we get in a comparison of getting into the stock with a naked put for lower price, the in-the-money long strangle position, or just buying a call option as well. So it's the 3 core principles in trade comparison from July 27th, 2017. Okay, yep, that's the one I want. So I'll send you the proper link to that one. You can kind of see it up here. It's here we go. Oop. Let's see, there we go. Okay, so that's the full link. I hope that works. If not, I can get you a better view there. That's my discussion there on why I don't use the in-the-money long strangle position as a substitute for the married put. Follow-up question for William. He says, thank you for your explanation there. Would the dynamics change if the long call was further out in time than the long put? No, because it would be a higher cost. So when you're looking at the expiration at the halfway point, you're looking at the value, theoretical value 1 month out, for example, and so forth. What you end up seeing is that you're going to have more time value, you're going to have more percentage risk against your cost basis as well in that case. I've had some investors try to do it a different way, where they bought the 6-month out call slightly in the money, or in the money with a delta maybe of 0.7, 0.8 as we were talking about, but then buying a year out put. And if they eventually wanted to take ownership of the stock, they'd exercise the call to continue the married put, or they'd make adjustments on the call. I don't know how well that worked. I haven't tested it myself. But I think the reason why is that they wanted to pay into less time premium on the call instead of owning the stock, but still have the long-term protection in place with the put if they're wrong and it moved down in price. So I think that was the approach, but I'm not sure. I just use it generally to show the same strike price, the same expiration date, William, to mimic the fact that the stock doesn't have an expiration date, so I feel that's a fair comparison. All right, I'm going to go in order, and what I'd like to do is go through all these questions that have come in and try to group them together. But I don't think I'm going to have the opportunity because, as I mentioned, I think we're now up to maybe around 30 questions that have come in, which is fantastic, but I'm going to waste more time scrolling through them to see which ones go together as well. Rex says, since married puts are so safe, why do you advise against using margin? It's because when you use margin, then you don't have the same risk profile. You take on a higher sort of percentage risk. Now, there's 2 forms of margin. Borrowing the shares on margin, which usually requires you to pay a borrowing fee, which increases the initial risk, which is also the problem. But then there's something called portfolio margin, which we do discuss, Rex, which we would use. And what the portfolio margin idea is that if I enter a married put position, say on, this is my real position on KHC, which carries with it a 275 risk, some brokers allow portfolio margin, which means what? Which means I only have to put up the 275 that's at risk in the position, freeing up more of my capital to potentially do more married puts. If they allow that sort of margin, we kind of say it's okay. But if I'm borrowing 50% of the shares to get a lower cost basis, so I'm borrowing 50 of the shares and then I'm paying a fee for borrowing that 50 shares and using the margin, you might already be paying monthly anyway for the right to use margin, so you don't have an extra fee in that case. But if you do have the extra fee, that's going to be adding to the risk over time and putting you in the opposite direction as well. Okay, so 2 types of thing there, but yeah, we don't advise doing margin on it because people have a tendency to overtrade REX at that point and overextend themselves and not have the money to cover the potential obligations. But you said if married puts are so safe, why don't you advise doing it on margin because investors can't get them in trouble? And really, honestly, it is about just the safest thing you can do with options because it's not only a known risk, it's a controlled risk to only 5 or 6%. You can get that with standard collars, but it doesn't give you infinite upside. And you say, well, oh, isn't the reverse the same thing in the sense of a married call? Isn't a married call the same thing as one of the lowest risk positions? Yes, but remember, to do a married call, you're shorting the stock, which means you're borrowing the shares, that you're borrowing the short, so you're paying a fee that time, the whole time that's open, which also is increasing your risk on a small basis, but still increasing the risk in that case. And that's not what we want. We want to be decreasing the risk as much as possible. Okay. All right. So let's see here. Dan. Oh, Sam had another thought relating to the margin, I believe. Sam says, with the margin married put, if the married put, you will still lose in an upside on the rally of your stock. I think that's what you're referring to. So if there's a large rally, and we only have that there as well. All right. So Daniel's question. With your experience doing radioactive trades, the married put positions, can it replace a continuous income, like example, a job, in every scenario like a falling market? Or should I create some other source of income on top of it? Well, I don't. Remember that the married put is a way to preserve existing capital to protect what you have with the ability to generate income. But Daniel, you can't force income incorrectly on a married put position, as you and I have talked before in the past, because you can actually put yourself in a worse position. Example, this is a lower price one, but let's just take Dropbox. I'm going to open a married put on Dropbox because I like the stock. It's a nice 7.4% risk, and I'm out to January 23. And I say, well, I've got 7 of these open, not 7 Dropboxes, but I got 7 married puts, Daniel, open. I need to generate income, even though the market's falling, to replace a second job loss or initial job loss. I need to generate income, but I need to start doing it now. So I got my 23 put, the stock's at 1960, want to go out a few days, let's stick with May 15th, and I'm going to sell the 20 strike call for about $1. So maybe it's worth $1,000 if you had 1,000 shares, but we're going to collect $100 here on our 100 shares. Now remember, I would have opened the married put because it's a stock I wanted to own long-term potentially, or stock that I thought was going to help me, Daniel, or was bullish on. If it goes against you, did you generate income? Yes. You took in $1. What did you also do? You gave yourself, by forcing the income too soon and at the wrong strike price, you give yourself an upper and a lower break even. You increase your risk to 16.3%, not to the downside, but the upside in the direction you thought the stock was going to go. A lot of times it's not worth it, if your long-term outlook is bullish, to try to force income on the married put structure, which is protected, and it's designed to preserve your capital long-term that you want to keep. You don't want to lose in down markets. You want to protect it. You want to hedge it. That's what the married put's for. But it is a bullish structure. If I sell the call too soon and too low at a strike price because I'm trying to force income in this situation, I can give myself 2 ways to lose, and I could double my loss in the upside in the direction I thought the stock was going to go. So to answer your question, the married put is the best way to protect your holdings, the best way to protect capital that you want to preserve in uncertain markets, with the ability to generate income, lower the initial at risk, and potentially bulletproof the trade. Am I going to say it is the best approach to consistently generate income on a weekly or monthly basis to supplement job loss? No, because if you force it, you can. It's the best protected way to generate income, don't get me wrong, but forcing it to have to generate income to supplement security and salary that you had from losing a job, for example, you can actually hurt yourself more. You can put yourself in a position where you're taking more risk to the upside in the direction you thought the stock was going to go. There are other strategies for declining markets, of course. We can talk about bear call credit spreads, which usually take a 7-to-1 or 8-to-1 risk reward. That's why it should only be done with a portion of your portfolio, maybe 10, maybe 15%, usually no more, because of the risk involved if you're wrong in the direction, the 8-to-1 risk-reward factor. In declining markets, we also talked about the calendar put spreads, the diagonal calendar put spreads, sort of that we were just talking about with Eric, but he was using horizontals in that scenario. To preserve capital, avoid large losses in uncertain markets, the married put, I feel, is the best approach. You know you have single-digit risks on the larger amount of capital that you want to preserve long-term if you're going to be trading. Of course, okay. Comment comes in from Tom, well, the safest thing to do in a down market is to stay in cash. Okay, you're right. But I'm answering the question that's coming from Daniel. In an uncertain market, is the married put structure the best way to consistently generate monthly income to replace salary from potentially a job loss? And the answer is you still have a low-risk position, but if you try to force the income method at the wrong time, sell the wrong call at the wrong strike or for too low of a premium, you're going to give yourselves 2 ways to lose. This is not a big move, right? It's at 20, the upper and lower break-evens at 22 and at 17, with the stock trading at right about 20. So it's a pretty percentage-wide. That's a pretty wide upper and lower break-even. But in these kind of movements where we see $20 stocks drop $1.50 to $2 a day or beyond, then that's what we're going to see as well. Okay, in those cases. All right, so that's my answer for that one, Daniel. And Dana says, I appreciate your mentorship. I need that. Yeah, but it's still probably the safest way to protect the downside if the positions start to fall, as I mentioned. Yeah, and I mean, another comment comes in here is that, well, if the stock falls, you've lowered the risk to the downside. This risk is the increase to the upside. We took our 7.4% risk, I think it was. We've lowered it by that dollar we collected. So we've lowered the max risk to the downside. So if the stock falls, we do have lower risk. But what am I going to do then? I'm still losing on the stock, and I'm getting closer to that max risk and sell another call way down here. Well, if the stock rebounds, now I'm in a worse situation. Okay, but there are things you can do in a bearish market, and that's taught in the blueprint as well there with the limited risk in place. All right.